Now for more on all of this market volatility, we are joined by David Nelson. He's the Chief Strategist at Belpointe. David, thank you for joining us.
Thanks for having me.
Really rocky day on Wall Street.
It was.
Investors reacting to just a whole laundry list of bad news. We've got another Ebola case here in the U.S., ISIS in the Middle East, lower oil prices, and of course weakness in Europe. Of all the headlines out there, which one do you think the market is paying the most attention to right now?
The broad market is paying the most attention to what's going on with interest rates right now, but I got to admit, the Ebola scare today, this morning, futures were reasonably stable very early this morning when I got up and I saw that Ebola headline, and I knew it was going to be a rocky day.
And what would really be the impact of the Ebola scares? I mean, the airline industry, obviously,
sure,
but what other sectors?
Probably not much economically. It just, given the weakness that we've seen in the broad markets, it's just another nail in the coffin, so to speak. But the interest rate situation, watching the 10-year U.S. Treasury go below 2%, that's frightening
right,
for
that
professionals.
Indicates fear.
It does indicate fear. And if you think about it, over the last several years, central banks around the world have spent trillions of dollars trying to get, some form of inflation going on. And we're not seeing it. We're seeing deflationary forces around the world, especially when you look at something like oil hitting new lows.
Right, exactly. And I mean, do you think that the low oil prices is one of the most worrisome signs in terms of deflation, that it could cause a drop in prices rising and demand for, I mean, what does that tell us?
Ultimately, low oil prices will be a very good thing for the world.
Short term, right? I mean, in terms of...
Short term, right now you're seeing a mass liquidation. Hedge funds are very leveraged. Coming into the beginning of the last quarter, the quarter that's being reported right now, a lot of professional money managers, including myself, we were overweight oil. If you stayed overweight oil during that quarter, you were wiped out. And we may have put in some kind of capitulative bottom today. Oil did stabilize at the lower end of the range today. So that was at least a positive sign. Ultimately, it's a good thing, but in the meantime, we're going to ask questions. What does it mean about growth? And part of this, of course, is just way too much supply. The Saudis are pumping oil like mad.
And here in the U.S., too.
Yes, we are.
Right. So in terms of positives, though, to look forward to, we're just starting earnings season. Some of the banks have come out with their numbers. They've actually been pretty good, but market hasn't reacted too well to it.
Yeah, I listened to the banks.
Citi was good. But, I mean, do you think that this earnings season will be a positive factor for the market? It's
mixed so far. We're still very, very early in it. I listened to the bank earnings yesterday. J.P. Morgan was on the tape. Citigroup was the best of those, but only because they really, beat expectations. I listened to the commentary from James Dimon, and, it's the obligatory things are looking better. Bank of America didn't go over so well with investors. The banks still have a lot of legal costs. And then you just mentioned it in the lead-in coming in today. Then you have a Netflix, which is a momentum stock, not indicative of the economy, but it's down over $100 in the aftermarket. Pretty worrisome.
What do you make of this? I mean, are we headed for correction territory? Right now, we're down about 7% from our highs, and we've wiped up almost all the gains on the S&P 500 year to date. Is this just going to be a mild correction, or are we headed for a bear market?
I wish I could tell you the answer. I was kind of hoping here. Nobody really knows for sure, but I will tell you, I wasn't that long ago, a couple of weeks ago, I was here, and I was talking about the line in the sand being the 120-day moving average. That's a long time ago. We went through the 150, the 200, and here we are where the S&P has given back pretty much most of the gains, and we've got possibly a week open in the morning right now. What I need to see for this bottom to be in, we need to see some sort of rotation. Investors have been hiding out in utilities.
Defensive stocks.
Yeah, defensive stocks like consumer staples of Procter & Gamble. That's not going to lead us out of here. We're not going to get out of this on the backs of a Dominion or a Con Edison. We need to see tech, financials, and industrials in particular, which haven't reported yet. They have to do a lot better.
Okay, so a lot will be pinned on their earnings, you think, in terms of perception?
I think a lot depends. We've already had a couple of the technology earnings, and by and large, most of them were good. Intel's numbers were reasonably good. It did get a downgrade from Morgan Stanley this morning. That's what knocked it down, along with the market.
Okay, so really quickly, what's an investor to do in this market? Sell, buy into it, hold? What do you suggest?
First of all, if you're an individual investor, trading around the wiggles and trading around the big corrections and the big swings in either direction, that's going to be pretty tough to do. What you need to do is sit down with an advisor if you don't have one. If you're 25 years old, forget about this. All your money should be in stocks. But if you're 50 years old or approaching retirement, you shouldn't have all your money in stocks. And as a matter of fact, if you're in a balanced portfolio, you're not doing so bad. Remember, bonds are up substantially on the year, so you've probably ridden through this pretty well.
Okay, so I was about diversifying your portfolio, I guess, particularly at this point, right? Okay.
Absolutely.
So one last question. In terms of a sector that you think would be safe to invest in right now if you did want to stay in stocks?
Well, I just named the two. You know, the utilities, as long as interest rates are going down, utilities.
But you wouldn't buy on these dips. I mean, Netflix down 15%. You wouldn't buy into that right now?
I don't happen to like Netflix. You saw an announcement coming out of all companies. I believe Walmart is going to start streaming. I believe HBO is going to be streaming. That's going to be spun out. You've got Amazon out there. This is going to be a very competitive, space in media. I don't think Netflix is going to own it, although they have a lot of customers right now. Those numbers that came out tonight were horrific. Right. And it deserves to be down.
All right, David, thank you so much for your thoughts today.
Thanks,
that was David Nelson, Chief Strategist at Belpointe.